Welcome to everything you need to know about finance. Today, we're taking a deep dive into, well, one of the most watched numbers in the financial world, especially when things feel a bit uncertain. It's got this really famous nickname, the Fear Index.
That's right, and it's called that for a reason.
Yeah.
This index, it's designed specifically to give us a real-time read on what the market expects in terms of volatility. How much prices might swing around in the near
Well,
future,
future meaning.
like the next 30 days. And because volatility, especially big swings downwards, often spikes when confidence drops, it's become this kind of shorthand for investor sentiment, particularly fear.
Got it. Okay, and before we really jump into the weeds here, just the usual reminder, everything we're talking about today is based on publicly available data and analysis. It's for informational purposes.
Exactly. We're here to help you understand this stuff, these concepts and the data that's out there, but it's definitely not financial advice.
Absolutely. So the index we're focusing on, the ticker symbol is VIX, VIIX, and the official name is the CBOE Volatility Index.
CBOE being the Chicago Board Options Exchange. They're the ones who calculate and publish it.
Right. And just looking at where it is right now, the data shows it's sitting around 18.09. That's actually up a bit from its previous close, which was near 17.26.
Okay, 18.09. Now, to give that some context, you really need to compare it to its history. The long-run average for the VIX is actually around 21, maybe a touch lower depending on the period you look at, but let's say around 21.
So 18 is, well, it's below average then.
It is. By historical standards, a VIX around 18 suggests a relatively calmer period. The market isn't pricing in huge amounts of near-term volatility right now compared to its average expectation.
But calm is relative with the VIX, isn't it? Because this thing can really move. I mean, just looking over the past year, its range is pretty wild. The low was about 10.62.
Right, very low.
And the high was up around 65.73. That's an enormous difference.
It really is. It shows you just how sensitive it can be to changing market conditions, to incoming news, to, well, fear creeping in.
And those aren't even the all-time records, are they?
Not even close. If you go back to moments of real market crisis, think about the 2008 financial crisis. The VIX went above 80 then.
Wow.
And even more recently, March 2020, right when the COVID pandemic really hit the markets hard, it actually closed at a record high, around 82.69.
82.69, compared to around 18 today. That contrast really tells the story, doesn't it? It shows you what this index is reflecting during those periods of just extreme stress and uncertainty.
Exactly. It's like a seismograph for market fear. It can go from barely registering to off the charts very, very quickly.
Okay, so that gives us a great picture of its potential range and its connection to market turmoil. So our mission for the rest of this deep dive is really to unpack this. What exactly is the VIX measuring? How do they even calculate that single number? What do different levels generally mean? And importantly, how do traders and investors actually use this thing?
All right, let's get into it. So fundamentally, what is it?
Okay, fundamentally, it's an index published by the CBOE, like you said, and its whole job is to capture the market's expectation of volatility for the S&P 500 index.
And those keywords are expectation and S&P 500 and near term. It's not looking backwards at how much the S&P 500 did move. It's trying to gauge how much the market thinks it will move.
Over the next 30 days, specifically.
Exactly. That 30-day window is key.
And this is where the Fear Index nickname really connects, right? Because it's tracking expected volatility, and big volatility often comes with fear.
Precisely. Volatility itself is neutral, technically. It's just the size and speed of price changes up or down. But in stock markets, historically, the biggest, sharpest moves, the really high volatility periods, tend to happen during downturns, during periods of panic or uncertainty.
So when the VIX is high, it generally means the market is collectively bracing for potentially large price swings. And investors usually read that as a sign of high risk, high uncertainty, high fear.
That's the common interpretation, yeah. It's less about which way the market will go and more about how bumpy the ride is expected to be.
Okay, so it's a measure of expected movement, not direction. But that movement is often linked to sentiment. Like, a smoothly climbing market usually has low expected volatility, right?
Generally, yes. And a falling market, especially a panicky one, tends to have very high expected volatility.
Which brings us to that inverse relationship you often hear about. When the S&P 500 goes down, the VIX tends to go up.
Correct. And when the S&P 500 goes up steadily, the VIX tends to fall. It's not a perfect one-to-one correlation every single day, but it's a very strong and persistent tendency. It's one of the main reasons people watch it so closely.
Okay, that makes sense. We know what it is, why it's called the Fear Index, but the how. How do they actually calculate this single number? It sounds complicated.
It is somewhat complex under the hood, but the core concept is actually pretty neat. It's not based on looking at past S&P 500 price changes, which is how you'd calculate historical volatility.
Right, you said it's forward-looking.
Exactly. It gets its information from the prices of S&P 500 index options.
Options, you mean like puts and calls. The right to buy or sell the index at a certain price by a certain date.
Yes, exactly those. The price someone is willing to pay for an option reflects a lot of things, but a key component is the market's expectation of how much the underlying thing, in this case, the S&P 500 index, is likely to move up or down before that option expires.
Ah, so the options price itself contains information about expected future movement.
Precisely. That expectation embedded in the option price is called implied volatility. It's the market's implied forecast.
Okay, so historical volatility is like looking in the rearview mirror, seeing the bumps you already hit. Implied volatility is trying to read the road ahead based on how much insurance people are buying through options.
That's a really good analogy. The VIX calculation takes a whole basket of these S&P 500 options, both puts and calls, across a wide range of strike prices, focusing on those that expire in the near term, specifically between 23 and 37 days out.
Why that specific window?
They use a weighting method to blend those options to arrive at a constant 30-day measure of expected volatility. It's designed to always give that 30-day forward view.
So it aggregates all that option pricing data.
Right. It crunches all those implied volatilities together using a specific CBOE formula and boils it down to one single number. That number represents the market's consensus expectation for S&P 500 volatility over the next 30 calendar days, expressed as an annualized percentage.
Okay, annualized percentage. So a VIX of 20 means the market expects volatility equivalent to a 20% annualized standard deviation of returns.
That's the technical interpretation, yeah. But most people just think of the number itself as low, medium, or high.
And this calculation method, has it always been this way?
It evolved. The VIX was actually first introduced back in 1993. Initially, it was based on options on a different index, the S&P 100. But in 2003, they updated the methodology to use the broader S&P 500 index and the current approach using this wider range of options. That's generally seen as a more robust measure for the overall U.S. market. Got it. S&P 500 options, expiring roughly next month, feeding into this implied volatility calculation. So now, interpreting the number itself, we know the extremes, like 80 plus ends, and we know today it's around 18. What's the general rule of thumb?
Yeah, there's a pretty standard way market watchers think about the levels.
Let's hear it.
Generally, a VIX reading above 30 is considered high. That signals significant expected volatility, heightened uncertainty, and usually a good deal of investor fear. That's the zone you tend to see during big market sell-offs or crisis periods.
Okay, above 30 is fear zone. What about the other end?
Values below 20 are generally seen as low. They correspond to periods where the market expects stability, less stress, smoother sailing. You often see the VIX below 20 during steady market uptrends or periods of complacency.
And you mentioned the long-run average is around 21.
Yeah, somewhere around 20 or 21. So levels around that average suggest, well, average expected volatility. Nothing too extreme being priced in. Levels below that, like the current 18, suggest the market is anticipating less choppiness than usual. It really does sound like a quick snapshot of the market's anxiety level.
That's a great way to put it. It quantifies that collective tension or the lack of it. When you saw the VIX spike over 80 in 2008 and 2020, it was reflecting absolute panic and the expectation of massive daily market moves.
Okay, that makes interpreting the level much clearer. Now, can I, as an individual investor, just buy the VIX if I think fear is going to rise?
That's a crucial point. No, the VIX index itself, that number like 18.09, is just a calculation. It's a benchmark. You cannot directly buy or sell the VIX index like you can buy a share of Apple stock.
Okay, so it's not tradable directly. How do people actually use it then if they want to hedge or speculate on volatility?
They use products derived from the VIX. Financial contracts whose value is linked to the VIX index. The main ones are VIX futures contracts and VIX options, which are traded on the CBOE.
Futures and options on the VIX.
Right. And then there are also exchange-traded products. You might know them as ETFs or ETNs that are designed to track indices based on those VIX futures contracts. So they offer another way to get exposure, though they have their own complexities.
So through these derivatives, people can essentially make bets on where the VIX is going or use it strategically.
Exactly. And there are several key ways they do that. A big one is portfolio hedging. Remember that inverse relationship? VIX up, stocks down.
Yeah.
So if you're worried about your stock portfolio falling, you could buy VIX futures or VIX call options. If the market tanks and the VIX spikes as expected, the gains on your VIX position could potentially offset some of the losses on your stocks. It's like buying insurance.
Using volatility exposure to protect against stock market drops? Makes sense. What else?
Well, pure speculation, of course. If you just think volatility is set to explode higher for some reason, you won't go long VIX futures or calls. If you think things are calming down and the VIX is too high, you might short VIX futures or buy puts. You're basically just betting on the direction of expected volatility.
Betting on the fear index itself.
Yep. Another strategy involves something called the volatility risk premium. Historically, the implied volatility priced into options, which the VIX reflects, tends to be slightly higher, on average, than the volatility that actually ends up happening, the realized volatility.
So the market kind of overestimates the bumps ahead, usually.
Slightly, on average. Some traders try to capture this difference, often by selling VIX futures or options, essentially collecting that premium. But that's a risky strategy because if volatility does suddenly spike much higher than expected, those sellers can face huge losses.
Selling insurance can be profitable until a hurricane hits.
That's a fair analogy. And then there's term structure trading. VIX futures contracts don't all have the same price. Contracts expiring further out in the future might have higher or lower prices than near-term contracts, creating a curve.
Like prices for different delivery dates.
Exactly. And since volatility tends to revert to its average over time, it doesn't usually stay extremely high or extremely low. Forever traders analyze this VIX futures curve and place trades based on expectations of how it might change or flatten or steepen as volatility reverts.
Wow. Okay. So there's a whole complex world of trading just based on expectations of market swings.
Absolutely. And the VIX is the main benchmark for the broad U.S. market. But it's worth mentioning quickly, there are similar indexes for other markets, like the NASDAQ 100, that's the VXN, or the Dow Jones VXD, and even different time frames for the S&P 500, like a 9-day VIX or a 3-month VIX.
So you can get a sense of expected volatility in tech stocks specifically, or over shorter or longer horizons.
Right. And just to add one more layer of complexity, there's even an index called the VVIX.
VVIX.
Yeah, VVIX. It measures the expected volatility of the VIX itself.
Wait, the volatility of the volatility index.
You got it. Some people call it the volatility of volatility. It basically tries to gauge how much the VIX itself is expected to jump around. You could see it as a measure of how uncertain the market is about the level of future uncertainty.
Okay, my head is starting to spin slightly. That's meta. So we've covered a lot. What it is, how it works, how to read it, how people trade around it. But is everyone convinced the VIX is the be-all and end-all fear gauge? Are there criticisms?
Oh, definitely. It's widely used, yes,
Yeah.
but it's not without debate and criticism, like pretty much any market indicator, really.
What kind of things do critics say?
Well, one common point is that maybe the VIX reflects the current supply and demand dynamics in the S&P 500 options market more than it reflects a truly accurate forecast of future actual volatility. In other words, is it measuring the current cost of buying portfolio insurance, or is it accurately predicting the storm?
So it might be influenced by how many people are rushing to buy puts right now, for example.
That's part of the argument. Some academic research has also questioned whether its predictive power is really that much better than just using simpler measures, like looking at how volatile the market has been recently, the historical volatility. The evidence there is kind of mixed and debated, as you'd expect.
So maybe it's not the magic crystal ball some people might think it is.
Perhaps not perfectly magic, no. There are also just fundamental questions about the concept of volatility itself. It's complex, maybe not fully understood, hard to model perfectly, and anything based on it will inherit that complexity.
And any other issues?
There have also been some controversies. Over the years, there have been studies and allegations suggesting potential manipulation in the VIX settlement process or the VIX futures market. That adds another layer you have to be aware of.
Okay, so it's a powerful tool, widely watched, but not perfect. It has nuances, potential limitations, and has faced some scrutiny. So let's bring it back to listener. If someone isn't planning to trade VIX futures or options, why should they even pay attention to this number? What's the real relevance?
That's the key takeaway, I think. Even if you never, ever trade a VIX product, just understanding what the VIX is telling you provides really valuable context for the overall market environment.
How so?
Well, it's like taking the market's temperature or checking its pulse for anxiety. It gives you a quick, quantifiable read on the general sentiment. Is the mood out there one of calm and confidence, reflected in a low VIX? Or is there tension, nervousness, expectation of trouble ahead shown by a high VIX.
So it helps you gauge the background noise, the level of perceived risk.
Exactly. When you see headlines about the market dropping, looking at the VIX can tell you a lot. Was it an orderly pullback with the VIX barely moving? Or was it a panicky sell-off where the VIX shot up dramatically? That context is important.
Yeah, understanding the character of the move, not just the direction.
Right. And that understanding can subtly inform your own perspective on risk, not necessarily prompting you to trade the VIX, but maybe just making you more aware of the environment. If the VIX is really elevated, it signals that market participants, on the whole, are braced for bigger swings. That might just be useful information to have as you consider your own long-term investment strategy and risk tolerance.
It's like knowing whether forecasters are predicting sunny skies or a potential hurricane watch. It doesn't mean the hurricane will hit, but it tells you what the consensus expectation is right now.
That's a perfect way to summarize it. It's the market's 30-day weather forecast for choppiness, based on how everyone is placing their bets in the options market today.
This has been really illuminating, a great deep dive into the VIX. So just to recap the main points, the VIX is the CBOE Volatility Index, measuring the market's expectation of S&P 500 volatility for the next 30 days.
Derived from S&P 500 option prices, making it forward-looking.
Often called the Fear Index, because higher readings usually coincide with market stress and investor fear, showing that strong inverse relationship with the S&P 500.
And while you can't buy the index itself, traders use VIX futures, options, and related ETPs for hedging, speculation, and other strategies.
But it's not without its critics or complexities.
Definitely not. And remember, this is all for your understanding. It's not advice on what you should do.
Absolutely. So as we wrap up, maybe a final thought for you, the listener, to consider. The VIX provides this unique real-time window, not into what has happened, but into the market's collective anticipation of what might happen regarding volatility. It's purely about expectation.
So when you see the VIX at a certain level, maybe ask yourself, what does this current reading, this fear level, suggest about how investors are collectively positioning themselves right now? What kind of potential future are they bracing for? Or perhaps, what kind of future are they perhaps not worried about?
It's a fascinating glimpse into the market's forward-looking psychology. Something to think about. We really hope this deep dive helped clarify the VIX for you.
Yeah, thanks for joining us to unpack it.